I think more broadly, you need to have a valuation framework that says that, what is reasonable valuation and growth at a reasonable price or growth at reasonable value is the right approach. I also very firmly feel that India is not a value market. Right? They started behaving like growth stocks, and they were available at a cheaper price compared to growth stocks, which are also growing at similar rates, but are trading at a much higher multiple. So the switch from sort of growth to value was more that it was a valuation trade wherein you had a lot of high growth sort of coming in so-called value,
in the so-called value space,
and so on and so forth, and they started behaving like growth stocks, right? So when you look at it from a growth perspective, one thing is that don't take a macro view to growth and say that, I'm going to only do this, I'm going to only do that. I have certain idea of what constitutes growth stocks, I'll only buy that. I think you need to have a little bit of a broader approach.
And that gets rewarded.
Right?
So even when you see value or value labeled stocks picking up, it's basically the market is rewarding growth there. Just that they are available at better valuations, relative to the growth
and therefore, for similar growth, you would always want to buy.
Obviously, buy reasonable, right?
So that's the point I'm getting to, that you start with the growth.
Understood.
And if you find two sectors or two companies having similar growth characteristics, buy the cheaper one, right? Because likely that it will get rewarded better by the market. So the valuation framework is important, but the valuation framework cannot drive your policy. It's growth first.
So growth is the hero, and the valuation framework is like pretty much a guardrail.
It's a guardrail, or it plays a supporting role, but it plays a very, very important
supportive role. Today in Axis Moneynomics, we have Sivakumar with us, who is the CIO of Axis Mutual Fund. I know he needs no introduction. He has been on this chair interviewing people, but have had the good fortune of actually taking the mic today and asking him questions. So Shiva has been with the AMC since the inception of the AMC, so he pretty much knows the Axis AMC life cycle. He's been tracking markets for over 3 decades now. He's also an alumnus of IIT Madras and IIM Ahmedabad. Markets always feels unique to investors, as in investors perceive it differently every phase of the market. But do you think there is any parallel to what's happening today with what we may have encountered in the past, the world may have experienced in the past, policies, geopolitics, all of it?
Thank you. So it's what they say, right? That history doesn't always repeat, but it rhymes. And the parallels of today, you can find it in history. And I was, looking at some very interesting parallels. Last financial year, we've hit a cycle low in terms of GDP growth, in terms of nominal GDP growth, which the government estimates at little over 8.5% year on year. Financial year 26, we saw GST collections net grow by barely about 7%. And GST is a very close proxy for nominal GDP. Whether I think it's not 7 because, you have had rate cuts in GST. So possibly the real nominal number is closer to what the government estimates, maybe 8.5%. That's the lowest for more than 20 years. You need to go back to fiscal 2003 or fiscal 2004 to see as low a growth number as we have seen today in terms of, or seen last year in terms of nominal GDP. It's also interesting that going back to that same era, many of the things that we see today have repeated. Very poor equity performance. Currency in that era, for example, between 2000 to 2004, went from about 40 to the dollar to 50 to the dollar, a fairly significant depreciation. IT stocks underperformed. Different reasons, but IT stocks underperformed. Inflation was ultra low. Today, we got used to relatively low inflation, but even so, last year we printed 0 on CPI, which is quite an extraordinary achievement, on the wrong side. And back then as well, you saw CPI print in a 2-handle, which for an economy which until then was used to seeing 6% plus inflation, a 2% CPI was also a shocker. So low nominal GDP led by low inflation, IT sector and general stock market malaise, currency underperformance. And guess what? Gulf War II versus Gulf War III.
Wow.
So I think,
was it a repercussion of Gulf War II or that period actually characterized?
It's kind of interesting that, well, that happened in 2003, which was close enough to the market bottom, right? And now, of course, we are in 26. And again, it has come after the poor economic performance in terms of macros, right? Now, I'm not saying that, like I said, it is not that history repeats. But there are some very interesting exits from that era which you also need to take into account. That is to say that, for example,
that is something which our viewers would like to hear now.
That the rise in oil prices in 2004 especially led to a spike in inflation. And I'm going to use a WPI number because that really, I remember it, and that's what the policy stance was driven on in those days. WPI inflation went above 8% and caused an entire sort of change in the outlook on the Indian economy, and people started saying, oh, rate hikes are going to come, and there's going to be more pain to come, and so on and so forth. And guess what? The next 5 years saw fantastic performance of the economy and markets, right? I think something in the rise of oil also contributed to break in that inflation psyche, that low pricing power, low inflation, and then perhaps you needed an oil shock or something to break out of that low nominal GDP number.
Oh, wow.
So if this time around also you get an oil shock leading to some inflation pickup, some pricing power pickup or something like that, which leads to a better inflation outlook.
And also
and therefore picks nominal GDP up. I mean, assuming that real GDP in India still continues to grow at 7.5%, if you have inflation going to 4.5-5% as the RBI projects, then you're looking at nominal GDP potentially reaching 11-12%.
The numbers that you'd like to see.
Yes.
Yes.
And why is this important? Because from an investor perspective, and you think of yourself as a foreign portfolio investor sitting somewhere in New York or London, and you're paying expensive multiples for India. You're paying 20 plus multiples for India, or at least you were a couple of years ago. To buy what? A 7%, 8% nominal GDP economy. There's no value. But somehow, over the last 2 years, we've had markets essentially go nowhere. Earnings have grown a little bit, and therefore valuations have corrected a bit. And if the outlook on nominal GDP suddenly looks at 11-12%, and then your Nifty level earnings growth goes up from single digit closer to those similar numbers. If you look at estimates for Nifty earnings growth, it's give or take close to nominal GDP, right? Because it represents the large cap, largest companies, and they will grow give or take close to nominal GDP. So suddenly your Nifty growth goes from 8% to 11 or 12%, and suddenly your mid caps and small caps are growing at 15 or 20%. Then the outlook on the Indian stock markets also change, right? So this parallels in terms of foreign outflows, underperformance of the currency, and so on, could well be reversed if we get a jolt which causes our entire economic cycle to upturn. Then the question really is there an actual economic upturn? And that's what we are evaluating right now.
Sure. Are there any other phases? I mean, this is a great parallel, right, between what happened around the 2003 phase. But are there, and obviously, over the past few years, we have seen a number of events which have shaken confidence in the market. Some of them have been very, very brief. The pullback has been sharp. Some of them have been a little more frustrating. Are there, any other parallels that you can draw which signify some kind of a similarity, or do you think this is the best one that we could dip into?
The worst thing one can say is that this time is different. So let's just say that markets live through all of this. Since we started here at Axis AMC, and I've been that when we started, roughly the Sensex, I'm going to use Sensex here because of nice round numbers, was close to 10,000. Now we are closer to 80,000, which means it's gone up 8x. But it's really interesting that the phases through which we've come over the last 16 odd years, it's not been an even path to go from 10K to 80K. The first doubling of the market essentially happened post GFC, very sharp pullback. It was more of a bounce, and economic momentum was still there from before the global financial crisis, because we didn't really have an Indian macro slowdown at that point of time. It was more led by an external shock, right? And then the markets pulled back very, very sharply. If you see the period from, let's say, 2008 end, 2009 beginning to 2012, the markets roughly doubled, right? Then there was a long period of, in some sense, crisis of sorts. You had taper tantrum,
True.
where India was seen part of the fragile five, and there was a lot of worries on the external sector. You had a bank credit cycle,
Absolutely.
NPA cycle.
2018.
You had an NBFC credit crisis, demonetization, and a lot of these economic shocks, which were largely led by India, meaning it was our factors,
domestic,
right? It was domestic-led shocks.
Yeah.
And guess what happened between 2012 and 2018? Market doubled again.
Yeah.
So 20,000 became 40,000.
Yeah.
Then we've had another series of shocks, but this time externally led. COVID,
Yeah.
the Russian invasion of Ukraine, and now the new Gulf War. And guess what the market did? Again, it doubled. 40K has become 80K in that same time frame. So we've had these, in some sense, regimes in the market where we have had different economic conditions, where you have had different shocks, where you have had different worries.
True.
But at the end of the day, when you look at it over 5, 10, 15-year periods, you have had extraordinary performance.
Absolutely. But you're coming back to some very nice things you spoke about, which is compounding, which investors like to, investors believe in compounding, but the experience typically, when as an investor, it looks like compounding is a very, very slow benefit that accrues to the portfolio to the extent of the entire journey becoming exceedingly painful. But from what you have walked us through right now, is it good to say that markets are actually doubling every 5 to 6 years? And is that a good forward outlook to have? Or is it just a hope in the current scenario of uncertainty?
Yeah. The rate of increase really depends on the overall growth of profits, right? So the percentage growth in profits in India historically has been well into double digits, and that's why the long-term growth of Indian equity markets has also been in double digits. It's basically the fact that your profit growth compounding over time, consequently stock prices compound over time. I don't think that has changed fundamentally, right? Although when we grew from, let's say for example, from the 90s till the mid 2000s, when we really unlocked a large amount of change in the economic framework, maybe we grew a little bit faster in terms of earnings growth, and maybe from a higher base we can't compound at the same rate.
At the same pace,
so that's fair and that's fine. So you can't necessarily say that just because we had that 2003 to 2008 where we had 2,000 on the Sensex becoming 20,000 on the Sensex.
Right.
I don't think we can really look at that and say that we'll again keep getting those kind of returns over short periods of time. I mean, short meaning 4 or 5 year cycles. The point is not that. The point is to say that if you are in the markets long enough, you do expect to take reasonable rates of return, which could be well into the double digits. But you will have these phases, like we have seen in the last, let's say, 18 months, 24 months, where you don't see much performance. You could also have large phases where you have large drawdowns.
Absolutely.
The question is that to ride over these and come out stronger on the other side or come out winner on the other side. It is impossible to predict today what the next year's returns will be, and I'm not even going to try to do that.
Sure.
But it's a lot more, shall we say, easy for us to make a call that over 5 years and 10 years, and you will make reasonable returns from stock markets.
Sure. So I'm again segueing from an answer on capitalization that you introduced in one of the earlier questions. So Shiva, from your perch, are you now seeing, and you have laid the landscape for us over the last, say, about 25 plus years. Now, from your perch, how are you seeing the equity markets, Indian equity markets, having evolved from a participation or a market breadth standpoint? If you can throw some color, and therefore, if the market breadth is changing or moving in a certain way, then how does investing in various capitalizations beyond large cap look today?
Right. It's a good question. And this is again cycles. Okay. Let's just walk through what has happened in the last few years to get a sense of what those cycles will look like. One is we mentioned that economic growth has slowed down. We didn't really delve into why, but both fiscal and monetary reasons as to why economy has slowed in the last couple of years. But even within that, performance has been very different across large caps versus mid caps and small caps. It's also worth therefore exploring what has changed in terms of the relative performance of these segments of the market, right? And one driving factor there has been the consistent selling by foreign investors in Indian equities. And this has been going on for the last few years. And even this year, for the first 4 months, we've already hit last full year.
The numbers of the last year, 1.85 lakh crore
Yes,
or some
so
such headline number
headline
today.
number. And that is certainly something which is of some concern. But what's really interesting is that domestic retail flows into equities has more than made up for the exit of foreign investors. And this is something new. I mean, again, if you go back in time, in the Indian investment, shall we say, outlook for the past, whenever foreigners used to sell, we used to worry that the markets would correct and so on and so forth. But now, domestic investors are bigger than foreign investors. It has also changed the micro, shall we say, structure of the market in some respects. That is to say that, what are the kind of stocks and segments that foreigners own that they can sell?
True.
Right?
Okay.
So typically, foreign investors are biased towards large cap to the extent that some of the foreign outflows have been on account of ETFs and index funds, because passive outflow has driven a large amount of this. It's going to be biased towards large cap.
Yeah.
A lot of foreign investors are not so heavily focused on public sector banks or public sector enterprises. So disproportionate selling of foreigners has been in sort of large cap sort of large cap growth, right? Whereas domestic investors have invested across more breadth. So it doesn't have to be only towards large cap growth. People have looked at other strategies, cyclicals, smaller companies, and so on and so forth. And we saw this in abundance back in 2024, where the first phase of foreign selling and domestic buying, the equity markets went up, but mid caps and small caps outperformed significantly.
Yeah.
As a result of this foreign selling and domestic buying, right?
But isn't it playing out this year as well, at least in the small cap space?
It is. But 25 tells us why. Because in 25, same flow, foreigners selling, domestics buying, and a large cap index like the Nifty was up some 10%, and let's say a small cap index, for example, was down 6%. So why is it that there's the same flow or same kind of flow? Why is it that mid cap, small caps underperformed in 25 and outperformed in 24? It comes down to a few factors. A big one of it is the US tariffs on India.
Sure.
And at a macro level, it can be argued that India's exports are relatively small as a percentage of GDP, quite true. And therefore, US exports are also small as a percentage of GDP, and therefore the tariffs impact on India is quite low. At a macro level, that's absolutely right. But India's manufacturing also is low as a percentage of GDP.
Sure.
And therefore, exports and manufacturing exports as a percentage of manufacturing is not that low.
Correct.
And why is this important? Because the tariffs were imposed only on manufactured goods. There was no tariffs on IT or services, right?
True.
And if you look at and that impact on the manufacturing sector is quite significant, or was quite significant. And if you look at index composition, the large cap indices in India are heavily biased towards things like banks, IT, domestic consumption, auto, which is also largely domestic, and so on and so forth. So you get this large cap, which is largely domestic driven or services driven. And where are all manufacturing companies sitting? They're sitting in your mid caps and small caps.
Okay.
The impact of the trade related shocks were felt more in the mid caps and small caps. And that's also why once the US Supreme Court ruling came through and this issue got taken off, and there's now talks of completion of a free trade agreement or some kind of a trade agreement with the US, but trade agreements also with other countries,
with Europe, etc.,
which have happened, is actually helping the manufacturing sector rebound, and that's also showing up in the relative outperformance again of small caps and mid caps relative to large cap this year, despite there being overall significant pain.
This is a great nuance actually to track. I have a number of follow-up questions on domestic flows and FPIs, etc. But coming back to FPI, Shiva, because that has been, it's not just FPI, it's also FDI, which seems to have taken a hit, right? And that's a very relevant number from a macro standpoint as well. Now, is it that this is a vote on or against India, Or is it that, is it more to do with what's happening in markets globally, especially say in the US where growth continues to remain strong, or it's an AI-led participation that they want, or is it also it has implications on rates, etc. So is it a vote against India or a vote for the rest of the developed markets, beginning with the US? I understand there have been flows in other Asian economies last year, which we sat out of, but many of those countries are seeing outflows as well this year. So just want to understand your thought on what is the character of this FPI outflow that you're seeing and the lack of FDI flow.
Short answer to your question, is it India specific or is it external?
Yeah,
The answer is
Is my report card poor, or is the US report card way better than mine, and therefore?
The short answer is yes.
Which one?
Yes. Yes to both.
Oh,
Meaning it's
okay.
there isn't a yes but or a this versus that.
Oh, is it? Okay.
There are some things which are India specific, and let's get those out of the way first, right? India is one of the few countries which consolidated fiscal deficit after COVID. Everybody had fiscal deficit explode during COVID and the year after.
Yeah.
As economies needed support, and governments really expanded deficits to help stabilize and grow economies out of COVID.
Yeah.
At its peak, India's general government deficit, that is states plus center put together, we hit about 13% of GDP, which is the highest we've ever run. Going back to any previous crisis, anything, we've never run this much of fiscal deficit. That number from about 13% of GDP is now down to about 7.5%. It's a material consolidation which has happened in the post-COVID era. It was massive consolidation which happened. The center itself from more than 9% to about 4.5%. So material consolidation at the center level, but also in aggregate when you include the states. Now, center plus states, the material part of the economy. I mean, you're talking about close to 30% of total expenditures. Expenditures by center plus states put together in aggregate is about 30% of GDP. It's not 1:1. It doesn't mean the rest of the economy is 70%, but I'm just saying it is material. And so when a large part of the expenditures are constrained in some form to control the deficit, it shows up in lower growth.
True.
And that reduction in fiscal deficit is definitely being seen in terms of low growth. But guess what else happened in 22-23? The Reserve Bank of India was in a massive rate hike cycles. We saw short-term interest rates go up by 400 basis points in a very short period of time. So again, it was not just the fiscal policy which was putting a downward pressure on the economy, it was monetary policy also which was putting downward pressure on the economy. Consequently, economy slows sharply. At 8% nominal GDP, we worry. It's low for us, right? But the rest of the world will be very happy with 8% nominal GDP, but for us it's not enough. Now, the two breaks, one has been lifted off. The center and the states are no longer consolidating. They're not expanding the deficit, but certainly they have stopped additional contraction.
Just a question here, is there a reason for us to believe that they may actually increase spending this year? There has been a lot of chatter, so if there is any thought that you can share on that.
We can get to that, and in general, the government has stuck to deficit targets, at least in the last several years. Starting assumption should be that there is no plan to significantly increase the deficit. If the war situation persists and oil remains elevated for a longer period of time, I would not be surprised if the government opens up its deficit target and allows for some of the costs of the war, essentially through oil prices, etc., some of it to be taken on the fiscal balance sheet rather than it coming through the economy. So, but we are too, too early in the financial year to make that decision.
It
will take time to make that assessment. So I think from a macro perspective, that's an option for the government, but I don't think they are going to be in any hurry to exercise that option.
So for now, we believe that we are going to meet those numbers.
We can be at flat, right? So that just means that there's no drag from that sector.
Understood,
Right? The RBI is completely flipped. Rate cuts, liquidity, as much as you want. And that is now transmitting to the real economy. So, if you assume a reasonable lag for monetary transmission, fiscal transmission, the consolidation till, let's say, 22-23, you can attribute a reasonable amount of slowdown that we've seen in 24 and 25 to the kind of consolidation we saw both from monetary and fiscal policy. The relaxation that we saw in 24 and 25 for monetary and the stabilization of the fisc ideally should have resulted that by end of 25 or 26, 27, we should start seeing acceleration. Are we seeing that? The answer is yes.
Okay.
Bank credit growth, which was
Yeah, of
languishing
course.
at 10% per
Yeah.
annum, is now running at 14-16% per annum. People don't borrow when they are feeling bad about the economy. People borrow because they're feeling good about the
Good
economy,
about
making investment decisions
Yeah.
or holding inventory,
Yeah.
whatever the case may be. Gold loans have shot up. Gold loans are all business loans. So the fact that people are borrowing just says that there is more confidence in growth going forward. It's a shocker to know that the April PMI number is higher than the March PMI number on every metric, including new orders, jobs, output, input. Every metric has gone up in April relative to March. It's astonishing that even as the war has progressed and in some sense continued with ceasefires and all, but with all of these issues, actually manufacturing sector seems to be saying that we are doing better.
We're doing well, yeah.
And demand conditions seems to be quite strong. We had by the December quarter already started seeing acceleration in earnings coming out of mid-cap and small-cap companies. I think yes, there will be an impact of this war in terms of supply constraints, higher commodity prices, and therefore raw material prices, margin compression, and so on and so forth. Maybe a quarter or two of real pain. And we must be mindful of the fact that this can in a worst case scenario, persist for longer and create more uncertainties. But if it's a one or two quarter problem, then the markets will look through that.
Okay.
And then look at the following subsequent quarters, and assuming that the underlying demand conditions are strong, we should start seeing uptick. As I mentioned in the early part of the conversation, that is about pricing power. We have started seeing, for example, some companies and sectors like FMCGs, etc., taking price increases after not being able to, because of relatively weak consumer demand. They're not really taken price increases in the recent past, and now they are taking price increases because of increases in raw material prices. But raw material prices can and should come down later in the year, and then what happens? Suddenly you see margin expansion. So that, if it plays out, you will start seeing the back half of the year, perhaps into early next year, where you will start seeing this momentum translate into the economy. So I think in many respects, the demand turnaround has started.
Right.
Supply will be constrained for a period of time, and that could put some damper to the whole thing. But as long as the demand conditions are there, supply can get shifted. Maybe if I can't deliver my product, my customer has a demand for a product, but I can't deliver because I don't have raw materials. But I can shift it to next quarter, it's still okay. But after how much of time will the customer say enough's enough?
Yeah,
right?
understood.
Or is it demand destruction? So yeah, if this was a long-lasting problem, then you have to worry about demand destruction. But for the moment, our working hypothesis is that the demand conditions are there.
Sure.
You may see disruptions for a couple of quarters on account of supply disruptions, but then we come back strong on the other side.
So if I can just summarize what you said, we went through a growth slowdown, which was brought about by our own fiscal objectives as well as monetary policy breaks that we put on our economy. We've kind of, I've heard you use this, we've kind of lifted our foot from the brakes, and therefore, our own doing to slow down our economy is no longer there. Which means that if the transmission lead time takes whatever it takes, from what I've read, monetary policy transmission usually has an 18-month ramp, you would know better. So that's already underway as evidenced.
I think it's underway. And when you add to this, what's happening in the rest of the world, right? The other half of the question was, is it because what's happening in the rest of the world?
True.
And you see, for example, who's won and lost in terms of the allocation from foreign investors? Now, obviously, US has been a beneficiary.
Sure,
US, AI trade, and investment cycle in the US has picked up very strongly on the back of power, data centers, and all of this stuff, right? Interestingly, a lot of Asian countries which have done really well in stock market terms have also seen outflows. Korea, Taiwan have seen significant outflows. They too have seen significant domestic inflows supporting their markets, right? Beneficiary in Asia have included China, which has also seen as kind of a beneficiary of the AI trade and of course valuations and so on and so forth, which has been very, really positive for China from let's say the situation 2 years ago. So we've seen winners and losers in the AM space, but one big winner has definitely been the US, where you've seen a lot of money flow. And particularly when it comes to AI, it's been a situation where AI as a theme has worked, but India is seen as a loser in that space, right? Where
But is that the right framing, Shiva? I mean, India being an AI loser somehow seems to me like being a little, trying to hurry up to conclusion.
Yeah.
And India may have its play in any of the multiple stacks that are a part of the AI.
This reminds me of how the tech bubble played out. More than 25 years ago.
Good
because the
analogy.
first cycle of tech, the real beneficiaries were the ones who owned the core tech. So, the networking companies, the hardware companies which built the internet, right? They were the ones who really performed in the first part of the cycle, right? But who eventually benefited from all that hardware?
The integrators.
The users,
whatever,
the ones
the
who could
way I
put it
call
to
it.
work, and
Yes.
software companies who were able to use that hardware to build software stacks on business and software and so on and so forth. Right? So the users of that technology eventually took more value than the ones who put those fiber optic cables and switches, right? Who were the initial beneficiaries of this. In much the same way, you will have AI cycle where the owners of the technology will be the first to benefit because they are the ones who have the differentiated technology. But eventually, economic value has to be reaped by the users of that technology. And that is where IT systems integrators, etc., can come into play. It's not suddenly possible that a large Fortune 500 company decides that I'm going to in-house all of my AI stack and get it. You will still need software engineers to come in and build that stack for you. And where are those software engineers sitting? They're sitting in India, right? So Indian IT companies will benefit, but there will be a pain along the way. Clients will expect AI usage by Indian IT companies, which means that they'll expect more productivity, which means that they will pay less, or they have fewer number of people and lower price point. So that there's in the near term there is a deflationary impact on the tech sector. How companies react to that is going to be very important, right? There will be some companies who will say win the deals even at a lower margin, it's fine. There are some who will say protect the margin and
give up on
deals.
Businesses.
And the different business models, we'll have to wait and see in the sense of who will win. We do believe that the right thing to do in many of the situations is to actually win the deal and be in the game, right? You can't sit out of sit out of deals and expect the market to reward you. You have to be there and you have to optimize your costs. You make investments and in terms of improving productivity and so on and so forth. So we will see how that pans out. So, but yes, Indian tech companies will come back, but they will come back in a very different way in this cycle. But that's not the only place to play AI. You are seeing a lot of data center investments. Some, because of this West Asia war, could shift from West Asian data centers to India. So you might see a kind of increased play in data centers in India. Now, data centers need electricity, so you need, more generation, more grid.
So power.
Power you need, and because of this war, there is going to be more focus on switching from fossil fuel based to electrification and renewables. So there's going to be. It's not just that AI and blah blah. You have to look at in the global context what sectors and themes will actually benefit out of these uncertainties.
So there are a lot of enabling sectors and themes that you think India is already in the race.
Of course. And if you have a large amount of data center capex or power capex, then who are the companies who will supply that?
Absolutely. Understood.
And that's so we need to expand our way of looking at it to see that, even in this disruption, there are still going to be quite a few winners. And can we find those winners and play those winners? Now, some of them, I must caution, are trading at extraordinarily expensive valuations. And so therefore, from a timing and from a relative return perspective, we must be cautious that we don't just run into any trade for the sake of it, but rather keep a very close watch on what valuations they're trading at, stocks and sectors, before you kind of say that, okay, thematically this is the right thing to do, and therefore you're going to jump all into it, right? I think that you have to focus on growth, but you need to make sure that you're not overpaying for it.
Okay. I move on to the equity markets now, and I'm just taking a cue from the valuation aspect that you brought into our conversation right now. So you mentioned that there is the war that's underway, etc., which is a drag on how on how the revenue streams or the margins, importantly, of Indian businesses gets impacted. So is it reasonable to say that FY27 is probably somewhere in the in the middle in terms of assessing earnings outlook, as in one quarter is already probably gone? Can we assume that? How is the outlook for earnings? And again, would you rather like a more segmented or nuanced approach, so you don't want to paint brush it as one common? And secondly, you mentioned valuation, Shiva, in the context of many of these AI enabling sectors or themes, etc. How important is valuation today when an assessment on earnings is peppered by a lot of external uncontrollable sort of factors for us? So your thoughts on earnings and valuation?
So I think I'm a lot more positive on the direction of earnings growth.
Sure.
There's disruptions in the very near term, but when you look at it, as I said, underlying economic momentum was returning from the middle of last year.
Until the war
to put on my old hat as a fixed income manager,
okay.
right? I'm going to just take a moment.
And they are very intelligent. They look macros.
Is that from June of last year, we have seen the long end yields, 10-year yields in India rise consistently.
Yeah, true.
Despite rate cuts, despite the RBI monetizing more than half of the fiscal deficit, centre's fiscal deficit, you have seen yields go up. So
almost 80% of net borrowings or some such number.
That rise in yields, despite that much of monetary support, has only happened because economic momentum has turned up. The market's pricing in better growth, better inflation, or higher inflation. I should say better inflation for the future.
Yeah,
right.
Better
so
for equities,
the better for equities. Yeah, we are normal asset class.
Yeah.
So the fact that you've seen such a consistent and pretty significant rise in long-term yields is, for me, a very strong signal that this is also an external validation of sorts that my thesis of economic momentum picking up in the economy is really holding true.
Understood.
And if that continues, that is to say that we
that's
see
a very
this
important
momentum,
signal you're pointing out to, very valuable.
If you see that momentum remain in terms of demand, again, I'll say that there's a difference in demand and supply factors right now. If the demand holds, supply shifting by a quarter or two, markets will look through. Right? If there is a demand collapse, obviously markets are going to get shaken. But if it's a question of everything is being pushed forward 1 or 2 quarters, there's no problem. Right? Equities are forward-looking, equities are reasonably longer-term looking. So in that sense, a quarter or two here and there of misses is not going to change the overall outlook on the market. The second thing is, when it comes to segments and sub-segments, especially large cap, mid cap, small cap, etc. I think large caps certainly are available at better valuations than mid cap and small cap, but the growth profile in mid cap, small cap is still better. So there is a growth valuation trade-off. And we do that at not just at capitalization level, but you have to look at it at a sector, stock, at every level. What is the growth versus valuation trade-off? The valuation is important because, as you say, the price is what you pay and value is what you get. So in that sense, you have to be very careful that you're not overpaying for the growth that you will receive. Right?
Understood. Yeah.
In a high growth environment, if you have extraordinarily high growth, you can have a growth at any price approach to your investments because let's say you overpay. For just to put some round numbers, right? For example, if earnings are compounding.
If you can expand on this a little more. Yeah.
If earnings are compounding,
basically, are you veering towards a concentrated growth environment?
No, I'm saying let's say for example at a stock level, sector level, economy level, I don't care. Right? Whatever asset that you're buying, if earnings are compounding at let's say 50% per annum. Right, and you have some notion of fair value, and you pay even a 50% premium to it. What does that mean? Within a year, you'll catch up to fair value. True. So it's only a matter of sort of giving up a year's performance, but you ride a longer term wave if that company compounds at 50% for the following several years. Right. So you don't mind, quote unquote, overpaying. In a scenario where you believe that there is extraordinary growth, which allows that intrinsic value or the fair value to catch up quickly to the price you pay. But if you don't have that kind of a growth, and you have a more normal growth rate environment, right? Significantly overpaying for any stock or a sector or even at a market at large means that you could be waiting many years for the underlying sort of fair value to catch up with you. And you look at the last couple of years at an overall index level, market's gone nowhere at an index level, but earnings have continued to grow, right? So at some level, you could say 2 years ago, maybe market was trading above fair value. I mean, there is no way to exactly measure this, but that's a way to look at it. You have a time correction of sorts, right? But the time correction can be very long if you pay a lot. Above intrinsic or fair value. So that's something to keep in mind, right? And it has to apply at you cannot have a broad brush saying that I'm going to have a metric which says I'll pay above, below, whatever it is, right? It has to be what is the value which you will get from future compounding of this earnings in this company or the sector or whatever it is versus what's the price I'm getting. In the ideal scenario, if I can get undervalued companies which have huge growth potential. But often that's not the case.
Scenario.
That's an ideal scenario that often doesn't happen.
Yeah.
Growth is priced and therefore priced. PRIZED versus CED.
Absolutely.
And therefore, wherever there is growth visible, there also tend to be somewhat more expensive. But that's okay, right? Because the idea for us as managers is to figure out within a set of stocks that's available, where even though the growth may be somewhat lower today, valuations are attractive enough that with a 2-year, 3-year time frame, as that growth returns to normalcy, we'll make money. Versus where is the growth visible today?
And how much
are we overpaying it? Are we overpaying for the growth, or is it available at a reasonable price? And this is a daily decision that we do as portfolio managers, and where to make those allocations and so on.
Okay.
So it's not that I'm saying I'm making it maybe sound a little easy, but it isn't, because
absolutely
we are going to keep every day. The market's always trying to be
stocks within the same sector may have a very different
growth and valuation profile.
So you said growth at any price may be okay in certain circumstances, but growth at reasonable prices may be okay, or maybe the right thing to do at a different set of circumstances. Is it possible for us or for you to show us some examples in terms of, say, periods? Because we started our conversation with phases of the market, right? Was there, or is there, I don't think now it is there from whatever I heard from you just now, but was there a phase in market where growth at any price won? And what is the market today? Is it growth at any price or growth at reasonable price?
I can think of 2 scenarios in the last 20-25 years where growth at any price worked.
Okay, which
One goes back to the 2003 to 2008.
Okay.
Where the overall market growth in terms of earnings was so strong, it didn't matter what you bought, stock, sector, anything and everything went up massively. Like I said, right, at a index level went up 10x. So it didn't really matter. Everything made you money.
Whatever you touched
made you money, right? So that's an extraordinary situation where we had a reset of the economy of sorts.
Understood.
Right? I don't think we are going to experience that. The second phase was probably that tough market environment of sorts between 2012-13 till 2000, around COVID. So let's say for that period, right, where if you actually break down the markets, the broader markets didn't do much. They were lurching from crisis to crisis, right? So there was, as we discussed, demonetization took some companies down. Then NBFC crisis took some companies down. Bank NPA cycles, you name it. You had taper tantrum caused a lot of disruptions to many businesses and so on and so forth. So you had multiple crises, and you didn't have breadth of outperformance, but specific sectors and stocks which were high quality, high growth companies. They did extraordinarily well. And this was in some sense our heyday in terms of performance, where high quality, high growth stocks were the one part of the market which went up, and essentially all the returns at an index level essentially came from a narrow set list of sectors and stocks.
Understood.
Right? And therefore in that scenario, if you approach with a very sort of tight valuation framework, you completely missed the boat.
You missed it. You were just looking maybe only for quality and growth prospects.
Even though those stocks were trading at a premium, they kept trading at a premium for a long time, and that was another phase where growth at any price. But here it was not at a broad market level; it was at a much narrower level.
Yeah, understood.
In a scenario that we are in today, we are not really seeing that. We are seeing more broad-based in the sense it's not thematic or it's not sector-specific that you're seeing all the growth focused in a specific area. It is a little bit broader. It's not as fast either. So there are specific phases of the market where growth at any price would work. But I think more broadly, you need to have a valuation framework that says that what is reasonable valuation, and growth at a reasonable price or growth at reasonable value is the right approach. I also very firmly feel that India is not a value market.
True.
Right?
Yeah, I get that.
The MSCI India Value Index trades at 19 plus times. 2 years ago, the entire Chinese stock market available 9 times.
9 times, yeah.
So there are, when you look at it in the global scheme of things, there is nothing called value in India. And the value stock outperformance in India in the post-COVID era happened because value stocks started showing 20+% earnings growth.
So basically, they started behaving like growth stocks.
They started behaving like growth stocks, and they were available at a cheaper price compared to growth stocks, which are
growth
also
stocks.
growing at similar rates,
Yeah.
but are trading at a much higher multiple. So the switch from sort of growth to value,
huh.
was more that it was a valuation trade wherein you had a lot of high growth sort of coming in so-called value,
in the so-called value space,
and so on and so forth. And they started behaving like growth stocks, right? So when you look at it from a growth perspective, one thing is that don't take a macro view to growth and say that, I'm going to only do this, I'm going to only do that.
Okay.
I have certain idea of what constitutes growth stocks, I'll only buy that. I think you need to have a little bit of a broader approach. Go for stock sectors, wherever it is that you see growth first. So first find where are the sectors or segments of the market where you expect to see growth, right? That's the starting point. Then you work, how much am I willing to pay for that growth? So the valuation framework comes secondary to growth, but eventually it's a growth rate that drives
and that gets rewarded.
That gets rewarded, right?
So that's even when you see value or value labeled stocks picking up, it's basically the market is rewarding growth there. Just
Absolutely.
that they are available at better valuations.
At better valuations, and therefore for similar growth, you would always want to buy
buy reasonable, right?
Reasonable price. So that's the point I'm getting to, that you start with the growth.
Understood.
And if you find two sectors or two companies having similar growth characteristics, buy the cheaper one, right? Because likely that it'll get rewarded better by the market. So the valuation framework is important, but the valuation framework cannot drive your policy. It's growth first.
So growth is the hero, and the valuation framework is like pretty much a guardrail.
It's a guardrail, or it plays a supporting role, but it plays a very, very important
supportive role. I get it, Shiva. This is very, very useful, especially the way you have taken us through those periods where growth stocks only did well and there was no room for value, and therefore growth at any price worked. But in this kind of a market where what you're seeing today is that value stocks are showing growth traits, but since they're available at better valuations, obviously, you're being the prudent investor and looking at growth at reasonable prices. So
and that's absolutely right. I think that's the right way to look at it. That growth first, but keep an eye on what valuations
are showing. Okay. So if I can reach out to the kind of last part of this conversation. So what I hear from you is, despite all the noise, despite all the headlines, which are more often than not negative and unnerving, especially for investors, right? What you have to say is that what we hear from you is that you're constructive on Indian equities. You're constructive on domestic equities. Firstly, right or wrong?
I am constructive on Indian equities. I think all of these negativisms kind of which have fed on ourselves in the last couple of years. We have seen them time and again in the past, where you have all the negatives come, and we call it markets climbing a wall of worry, right? That the worries are there, the negativism is there, and yet the markets keep going up, right? So that at the end of the day, the headlines and the narratives don't matter as long as there is performance underlying, meaning of the companies. If they are able to grow, then the worries and the headlines are great for talking about, but not the way to make investment decisions, right? So I think first is that from an investment perspective. The second is that please don't extrapolate last 1 year, 2 year performance.
Exactly. I was just coming to that. Please
next 5 years, 10 years when you're making investment decisions. Especially if you're young, you're making an investment decision in your 20s for potentially when you're exiting in your 60s or whatever, right? You're making an investment decision for the next 10, 20, 30, 40 years. And then we are looking the last 1 year, 2 years, and then drawing a straight line from there.
Or even the last month,
whatever.
Investors were investing monthly, right? SIP investors.
No, I think SIP investors are doing a great job, because you're taking out a lot of uncertainty around at what level should I buy, right? And that discipline that SIP brings you, I think, is still worth it. But when you do not confuse SIP with timing the market, right?
Sure, right.
Right, it's a discipline which works in an SIP, and not so much taking a view on the market, right? And so it's important that we take that slightly longer horizon and then say that, can I make an investment? What kind of decisions can I make today which will make a material difference to my returns from a, let's say, 5 years or 10 years perspective? Recently, I was asked an interesting question. I said that, early in your career, and early in my career, there was a dot-com crash, right? So would you rather have bought at the bottom of the crash? Would you have made a lot of money, right? Buying the dip or whatever you want to call it, etc. So I said, at that point of time, I had no wealth. Early in my career,
No
what money
disposable
for?
income.
No disposable income, no wealth. So in the scheme of things, how much I invested in 2000 versus 2002 didn't make much of a difference in my overall wealth because I didn't have anything to start with, right? There was not much to start with. So don't get carried away, especially if you are young, don't get carried away by that, should I buy today or should I wait for a correction or should I wait for something else? Because you never know where the correction, when the correction will be, at what price the correction will be. You start with something which is a price of 100, it goes to 110, 120, 130, you say, I'm going to wait for the dip, It goes to 200, eventually corrects to 180, and you say, hey, I bought the dip. You miss the entire move from 100 to 180.
Yeah.
You know, where's the joy in that?
Absolutely.
So, have a strategy. If you're going to allocate to equity, have a strategy, get allocated, right? And then don't try to sort of then get into this whole process of, okay, you know, should I time today, should I invest tomorrow, and so on and so forth. Have a strategy. By and large, as long as the markets go up, essentially, any reasonable investment strategy will make you reasonable returns. The question is that if you keep trying to hold cash or time, etc., it's I think a lot of work for very little upside.
So basically, you know, the wisdom of not timing the market, but time in the market, that should reward investors. My last question for the evening, Shiva, and a Charlie Munger fan, so I invert and ask you, in your opinion, okay, you meet so many investors, channel partners, you've been tracking markets now for 3 decades or more maybe. Over the next 12 to 18 months, what do you think will be the biggest mistake that investors might end up making? You know, it could be one mistake or more than one. And obviously, when you articulate that, investors know that that's not a mistake that they should make. So,
yeah, I come back to have an investment plan, right? And when we look at investment plans, very often the first thing we think of is in terms of making equity investments. But that's not the only place to be. Today, obviously, for many people, Indian equities will be a largest part of your portfolio. But have a look at global markets. There are places to invest in the rest of the world. India has underperformed massively compared to the rest of the world. And so we look today and say, oh, I wish I had invested and therefore I'm going to invest. Please don't invest on that basis. Invest for diversification and not because the performance in the recent past has been better, but rather from a diversification perspective. Also look at other asset classes. Why should all of our money be only in equity? How can we play a little bit of a portfolio in fixed income, for example? Can you do a balance advantage fund kind of a thing, which takes active calls between equities and fixed income? Can we do a multi-asset, which also brings in additional assets? So in that sense, can we look at it? Can we look at adding global multi-asset? And so the way you should look at your portfolio is that you can't take an equity only view to your life.
Absolutely.
So part of building an investment strategy is also to have a holistic view of your investment portfolio and see how I'm building it for, you know, it has to be built block by block, and everybody has a different risk appetite. Not everybody should be invested 100% in equity.
Thanks a lot, Shiva. So what I hear from you is have an investment plan, ensure that your asset allocation is in the right place, and you look beyond the boundaries as well. Thank you so much, Shiva. It was a very, very interesting conversation.
Thank you. It was really nice for me to be on this side of the conversation. I think for the last several episodes I've been doing the interviewing.
Oh, it's been lovely speaking with you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.